Здесь ты будешь работать.
Мне надо что-нибудь делать, помогать.
Следи, чтобы он не выключился.
Хорошо.
Okay, let's go. Thank you everyone for joining us. We have one free share. Here's one. Here okay, guys, so we are gonna grab your drinks. I think there's some wine left there if you want. And I think we are gonna start. We got so basically this is the new farming workshop by the protocol. And why we do this kind of event? Because we have this model which we call easy DeFi. Basically, we want to demystify the yield farming, and that's gonna be one of our presentations. So it's gonna be Vlad that he will tell more about the yield farming, and I think he'll share some yield farming strategies, right? Vlad?
Yes, sure.
So, and we have two more speakers today. One is gonna tell us more about the funding arbitrage, and another one. What's gonna be the third one?
Options.
Options, right? I don't really understand that. So, guys, I will tell more about the Leech protocol, like in the end of the presentation. I think you can ask any questions in the end of each presentation. Okay?
And now do it again. It's a simple DEX when you can make trades, you can provide the liquidity, and you receive the APR by incentivization from governance token or from any other product who want to make the farming here and who want to start the incentivization. Then we have here Leech protocol. The Leech protocol just launched it, and here I have in USDC pool on Venus 3,500 with 31% of APR. You will learn more about what is the Leech protocol and how it works soon, but it's good to have 31% of APR here. Then one fancy strategy. I want to explain you how to make a decentralized long position with some APR. So remember the first rule, don't trust taxes. And the thing is that we can firstly provide some ETH in Lido, 6,000 equivalent to USD as a collateral. You receive ST ETH in Lido, then you're going to Curve and minting CRV USD, only 3,000 because we need only 1.5 leverage here. Then we swap CRV USD to LDO and ATH, and then we invest LDO plus ATH in convex pool. And that's how exactly it works. So first you're going to start with a Lido. You go here, stake now. You stake it. I don't see here my stake because I put it into collateral inside of the Curve. And here it is 3.5 ETH. And that's my liquidation level. That's my health factor. Why I doing that? Because I able to borrow 3,000 of CRV USD. Now it's 3,040 because I pay an interest on borrowing. Then I put in this CRV USD inside of the pool on Convex. And here I have, because ETH went up a bit, I have almost 4,000 and total claimable $67. And the thing is, here I have $67 and around $12 because it was months ago. Gas wasn't too high. And the example here is like here I earned $67. It's almost 4K, and I borrow it here only $3,000, and I will pay $40 for this leveraged long. But this leverage is very low, it's only 1.5. And if ETH goes up, I will have more in the collateral, because in collateral I put in ETH, ETH and ETH is 3.5 ETH. Then my borrow still the same, but with some interest, like $40 or $50. And then I will earn more on ETH and Lido because it's also going up, and that's a leveraged long, decentralized leverage long, in which you receive some APR. So that's like free decentralized leveraged long. It's a kind of fancy strategy which you can make by your hands or by using Leech protocol. Then I want to talk with you how I usually research the farming positions and what I should take into account to make it more safety for me. So the first thing is, what are the project mechanics and the farming purpose? So you should understand why they're making the incentivization, because sometimes they can make the incentivization just to take your money and make it like your money gone. How to understand it? Go to the docs, read the docs, do your own research, and try to answer the question, why this protocol giving you money for free? That's the most important. The second one was the nature of the tokens in liquidity pools, because sometimes you can take USD Plus or dollar or USD Air, and get unpegged. And that's a problem because everyone thinking like, hey, we have a stable coin. The stable coin is fully pegged. We have amazing collateral with real estate. Then in chat, someone asks, is real estate is real? Because USDR now costs half of the price, is only 50 cents, but it was $1. So you should definitely understand what's the nature of the tokens in liquidity pools in which you're provided, and that's important. Then check the information about the ecosystem. What's the ecosystem? Are they growing? What's the users there? Because you might be only one who are farming there, and it will be hard to go out. What is the best way to in and to out, and how much it will cost you? That's the good question about the gas on Ethereum, because you should understand if you, for example, have the position with 15% of APR and want to change it to 17% of APR, but it will be on some fancy chain, you should use some bridge, you should transfer the money, you'll pay always gas fees, you'll pay always the commission, and you should take into account and understand for you, is it effective or not?
Are you using any tools for like this whole chain of operations, like to go out fast?
No,
Or do you
no,
do
you can, yeah, you can easily do it by your hands. Is no such tools here on the market. Maybe Fireblocks. Should it be? As a new startup.
Should they exist?
Does someone have money to invest in his startup? Hands up. You see?
No one has money, yeah? Go on.
So then you should understand what the final date of the farming, like when they will close the incentivization, and what's the actual APR. Because sometimes on the front end, they may write you like 100%, but in real it's 10%. So how to make it, how to understand it, you should take just $10, invest $10, receive the interest on $10, calculate it, and understand what the real interest and how it works, if there are any hidden commissions. About hidden commissions is 6. So what is the commission to join? Because sometimes on the level of the contract, they can ask you to pay 5%, 0.5%, or 10% just to join in. And if you invest only $10, you will understand it, and for you it will be not so hard like you invest now 10,000 or even more. Then 7, what is the reward token and what you can do with it? So sometimes you're receiving not a stable coin is a reward, you're receiving some fancy token, and you should know what it is. You're gonna store it, you're gonna sell it. For now, it's okay to sell it. The 8, what are the strategy risks and what can happen? And that's the most important thing, because we'll start with the risk of the wallet, then with the risk of the chain, then with the risk of the stable coins or any tokens which are you using, the nature of this token. Then we are continue with the risk of the smart contracts, firstly of the DEX, then of the smart contracts of the farming. Then we have risks of course, of the bridge tokens, and in final is some manipulative stuff which gonna be on the market, like a flash loan or something else. If some of the developers team lose the part of the mechanics, and that will be the economical risk. So that's how many risks you're taking to receive those APR, and you should understand it if it's effective for you or not. And the final one, what is the payback, given all of the costs, like what you will receive if you will deduct the price to join, the commission to join, the gas price, and if it's effective for you. No, 10 is a test all of this on $10 before starting. It's really, for me, saved a lot of money, because I just tried it on $10, and sometimes you got scammed, but on a $10, it's okay.
Can you actually calculate all of these risks because they overlap?
It's not possible to calculate it. It's like a benchmark.
I see.
So that's it.
So it's just like you come to a casino and see which machine is rigged. With $10.
What's the reason of your complicated scheme with all this curve, line, etc., that you can just stay alone with some text?
Stay along with some text is because I want to have a leverage it long. and I don't want to use text.
But
I don't trust
you
it.
have futures on that.
Yeah, you have, but you're paying for this future. You're paying the interest rate for this future, and it's the same, but I'm receiving interest.
What is ETH?
In total, it might be around 10-15% on ETH, because you are earn 4% from Lido, then you are earned from Convex, and in total it might be up to 10-12. From 4 to 8%. That's what I saw during the 3 months of using this. I started it with $300, and now it's because of ETH going up. So if ETH goes down, I might be liquidated like on regular checks.
On Curve.
On Curve. Yeah, on Curve with Curve USD. But my liquidation price for ETH is $800. It's not $300, but it's 8.
But can you be liquidated on Lido because you provided as a collateral $6,000, and the Ethereum will become 10,000?
No, on Lido you cannot be liquidated. Lido is like liquidity staking. It's, you can be liquidated on Curve with Curve USD.
But your collateral was USD.
No. My collateral was ETH in WST ETH. If you want to speak with me, we can speak after all of the presentations. I'm free to answer any questions.
So please meet Vlad, Degen and Leech Protocols Advisor. And Vlad basically asked me to present the Leech Protocol. And the reason why the product was born is because this presentation that Vlad just told us is fucking difficult. And the 95% of the total crypto users, they are basically afraid of engaging with the DeFi, right? The total crypto is how much is it? Like 1.3 trillion right now. Who knows that? Yeah. And the DeFi is basically 45 billions, which is like 3 or 4% of the total, right? So why is that? Because no one understands how DeFi works, no one knows how to do DeFi, and no one got the technical background basically to engage into the DeFi, right? So, and the UX is shit, right? And that's basically the big problem. And when we did like our own farming, because we got a team behind that, and when we did all this stuff like bridging, swapping, like changing blockchains, looking for like doing our own research, right? So it was really, really difficult. And this is why we thought that the product, which is going to be the one-click application, automated harvesting yields, right? So right now it's live. It's still in a beta mode with a maximum cap of 1 million TVL at the moment. But right now it works. And we are going to introduce the mixed pools like in the upcoming weeks. And the basics, like the mechanics of the public pools are that when someone provides liquidity to the mixed pools based on the chosen risk level, it's gonna take the liquidity and provide it to the different blockchains. First, we'll have 12 connected EVM blockchains. Right now we have 3 of them. And it's gonna separate liquidity across the different pools, something from the Vlad's presentation, something like Thena, I don't know, BSwap, YieldYak, and like everything else in the market. So basically it's gonna be a window for the DeFi, degens, and non-DeFi crypto audience, and later, sometimes and somehow for the outside of the crypto world, right? So this is the big idea behind the Easy DeFi, right? The frictionless DeFi to provide the access to the DeFi for those who doesn't have the background, the experience, and basically time to manage positions in the DeFi. So this is the idea. And this was the public one, and we have the Leech Club. Basically, it's the set of the CDFI, which is the decentralized finance, right? And those strategies are being developed at the moment. They are right now on the first tests, real on-chain tests. This is the hedging strategy simulation, for example. and it works really good, but we are not ready to provide this to the public until we have the real data and the real APRs and the real outcomes of the strategy. So if anyone interested in getting the updates from the Leech Club, just find someone from the team, and we will put you to the newsletter, and we will provide you the updates from the Leech Club's private strategies at the moment. So I think that's basically, if anyone got, we got the hedging strategy and we got the UniV3 strategy, but the APR is so huge that I'm not going to tell you that. Really, I don't think this is allowed. Be careful, right? This is not, actually, this anything from this presentation is the financial advice. Do your own research, look into the docs. We have the docs, obviously, we have everything structured in our website and our smart contracts. As Vlad says, like, do your own research, basically. And that's always, but yep, the UniV3 strategy works. It works good. The hedging strategy works. If someone wants to get updates, please come here and we will put you to the newsletter about the private Leech Club strategies. I think that's all, Vlad.
Yeah.
Right?
So, Sasha, your next one.
Good.
Да, нажми escape, у тебя там...
Так.
Okay. Hi everyone, my name is Alex. I'm asset manager, and today we are talking about options, general concepts. Yeah, what we will look at today. Firstly, the concept of options, their types, specifications, and also we will talk about buyer's expectation, benefits of trading. We will compare option trading and future, traditional spot trading. And also we will look at trading strategies, different trading constructions. Briefly, option, it is agreement between buyer and seller, and the buyer gets the right to buy or sell some asset with fixed price. At the same time, seller gets obligation to sell or buy this asset at the agreed price. About right. If I bought option, I may execute it or may not, as I want. It is my right. But seller of option, he doesn't have such great rights. He has only obligation. He is my counterparty. It is Thales of Miles, and this guy was first option speculator. Yeah, one time he decided that, okay, this year we will have great harvest of olive, and majority believed that no, we will have a bad season. That's why he agreed with owners of presses, and he agreed to use their devices during harvest season, and everyone was happy about this because he suggested them some amount of money for this right to use their devices. And this season was great and the harvest was large. That's why owners of devices decided to buy back their rights to use their own devices. It means that Thales sold his right for these owners before harvest, and it was first option speculation. I don't know. Yeah, he sold his all contracts before harvest. Let's go down to the level of amateurs, and let's imagine that options, they are like bets on some sport events. I don't know. In betting, there are fixed risk. Options have the same situation. They also have fixed risk. This risk named as premium. Premium, it is value, it is price of this option. The same story with deadlines. In betting, there are deadlines. In option market, there are also some deadline. It's called expiration date. It is last date of trading this option. A bet on price grow, it is call option. A bet on price fall, it is put option. It is how looks like option board. It is place where all options trade. One expiration, in one place. I understand that it might be a little bit confusing, but everything the same as any other exchange. There are also bids, ask, there are also limit orders, order book, everything the same, but a little bit more complicated. Let's study some new words. Firstly, it is underlying asset. It is underlying asset. It is asset what we want to make money on. It could be cryptocurrency, share on stock market. It could be futures or olive, for example. Strike, it is price which we have our transaction take place. Expiration, it is last day of our deal, of our option. And premium, it is value, it is price of the option. And it is max risk for buyer. He will pay this premium for his right to buy or sell some asset. Now we have all theory and all entire base in options. That's why we will look at different strategies. Firstly, we need to understand that there are only two options. It is put and call. When trader buy call, he receive a right to buy some option, to buy some asset, and he believes that this asset will grow. If trader buys put, he believes that our price of asset will fall. What affects the option price? The value of option, it is premium, is affected by mostly by three things. Firstly, it is price of underlying asset, for example, Bitcoin. Second, it is period till expiration, how much time we have till the last day. And last, it is volatility of the asset. There are more different aspects, but first three, it is the main. Yeah, I understand that option market, it is not the easiest. It is not such easy as buy spot, and that's all. And option traders decide to visualize all return yield profile on the simulator. It's how it looks like. Yeah, horizontal scale, it is price, and vertical scale, it is profit. But we can simplify everything. If area green, it is good, it is profit. If area red, it is bad, we will lose their money. +1, 37K, C, 29 December. It's how we will see name of option. +1 means that we have long position. 37K, it is our strike price when we started to earn some money or to lose some money. C, it means call. And if we will see P, it means put option. 29 December, it is expiration date, last day of this bet. Yeah, what do option buyers expect? When trader buys some option, first thing, he is expecting to return money, to recoup this amount of money which he spent on this option. And after that, he expecting that price will move in his direction. There will be some volatility, and the further the price moves, the more the trader will earn with a fixed risk. It is the main benefit. Maximum risk at purchase options is a premium what he paid. How to make million on options? In March 2020, when the price was hanging around 5,000 per coin, we could buy 280 call options on Bitcoin with a strike price of 60,000 with expiration in March 2021. We paid approximately 1,500 for this call options, and at expiration we will get a profit approximately $1.2 million. It is history. And what about now? Now we will have halving 2024. Nobody knows when it will be exactly, but it is something around May, June. And now on Deribit exchange, it is the biggest exchange, option exchange. There are options with expiration on June 2024 and September 2024. The highest strike for now, it is 140,000, and everyone can take call option. For example, it will cost approximately $800. That Bitcoin will reach this target, 140K. And in case when Bitcoin reach this target, this bet will multiply, I don't know, 10, 20 times. But let's imagine that history will replay, and we will have strike approximately 400,000, and Bitcoin will grow 10 times. In that case, we can use option, some option pricer. It is some soft which can predict price of options with some information, for example, time, index, future price, strike price, volatility. If we will have strike, if we have strike price 400K, it means that price of call options will be approximately nothing, and we can spend $100 to buy, I don't know, 20K of call options. In case when Bitcoin will reach this strike, all these call options will bring us, I don't know, 10K each option. Okay, benefits of option trading. First benefit, it is management of risk. You know your maximum risk, and in every position. No slipperage, no shutdown of exchange servers. It doesn't matter for you. Second benefit, you will spend and you will use less money for position on option market as on spot exchange, for example, to buy some spot, because inside every option there are leverage. And last benefit, but it is the most interesting, the most important, it doesn't matter how exactly price will move to your target. You will earn money in any case if price will reach your target. What I talk about, let's analyze this return profile. We buy +1, yeah, 37K put. It is approximately price at the beginning of this day, and in case when price, if price drove down to 26K, we will earn with using one option approximately 9K. On future market, if you open short position and price will grow, I don't know, to 99K, you will be liquidated, and that's all. All your short position will be ended. But in case with options, it doesn't matter. It will grow to 99K, and after that falls to 26K. You will earn your money. You will take your money, and you will not be liquidated. Yeah, I think that it is the most important benefit, because I'm sure that people who opened some short position on market and placed stop order, they faced with situation when price immediately grows. After that, stop order triggered, and you lose your money, your position. And after that, just immediately price fall down for 10, 20, 40%. The same situation with long position. If you open long position and place your stop order, price can fall some amount of percentage, and just after that, after triggered your stop order, will grow significantly. And if you faced with such situation and you hate such situation, option market will help you to solve this problem. Next, move on. When someone buy put option, he will have such profile, return profile, yield profile, yeah. But his counterparty will have such profile, and you can notice that here when you buy a put option, you have unlimited potential of profit but limited risk, and when you sell options, you have unlimited loss but limited profit. That's why that's why I recommended to not to sell options first time, only with some combinations. And next we will talk about combinations. First construction, option construction, it is straddle, long straddle. It means that we will buy one call option and one put option, the same volume, and in that case, this construction also named as I don't know where price will go, because in that case, trader bet that price will be strong, significant, but he don't know in what direction. Using this strategy, trader earn money on both sides. Price will down, here is green, we will earn. Price will go up, there is also green, also earn some money, but trader will lose money in case when price doesn't change. If you have prediction that price will stay in some range, you can use straddle short. It means that you sell some amount of options. In that case, you will earn between some break-even points. Break-even point, it is a price when our result will change from minus to plus, from plus to minus. It is 0 points. Yeah, it is really important on trading with options. And if you have some prediction with price range, you can use different strategies to work with this range.
You overlap this too also? I mean, to create a straddle, you overlap basically two different options. Yep. Can you overlap the two straddles also?
Yeah. You can open
cover the whole range with the ups and downs.
Almost all range. Yeah, you will have some places where you will lose money, but yeah, you can put strategy return profile, like I don't know, like hills, 10,000 hills.
What strategy you use?
We will go next. I have a question for you. Who believes that price of Bitcoin will be above 45K in next 10 days?
Not me.
Not you. And okay, maybe someone believes that price will fall down below 27K in next 10 days. No. Okay, then this option construction will works for you. It is have as for me it have low risk and low profit, approximately $400. But in next 10 days, if price it is one BTC.
1 month.
No, next 10 days, 1 BTC short call and 1 BTC short put.
So you have, what is the price of the premium in this
we can check.
I mean, you basically bet the price of the premium, as I understand.
Yeah. When you short,
and you have the 400 as a potential profit.
Yep.
You set the bracket with the straddle, yes.
Yep.
So what is your potential potential profit and what are the risks?
I don't remember now for sure the collateral for this position, but it will be approximately 1,000 as collateral, and you can open that position, and average profit it is 400 approximately in next 10 days.
The price of premium, not the collateral. So we are open.
Price of premium, it is approximately 200 for put and 200 for call, because it is almost symmetrical. And on option board, you can see that.
So you pay 400. So you said
No. You will receive. You put.
You use BTC or
Ethereum.
So-
You put
so
approximately.
I need to put one BTC, not $1,000.
Not one BTC. It will approximately 0.03. Yeah.
So I need the collateral like
Yeah.
$1,000.
Yep.
So the risk is $1,000.
Yep.
And the profit is $400.
Yep.
So
Yeah.
around 40% or in
10 days. Yeah.
let's do this.
Is this graph for selling?
For selling. Yeah.
Okay, so
Yeah.
you actually receive the premium.
You will
not
receive this
paying.
premium. Yep. When you buy, you pay premium. When you sell option, you will receive this premium.
But as I remember, when your losses are unlimited when you sell the premium.
When you buy, your loss is limited. When you sell, your loss is unlimited. You see that
And
here.
you sell in this case.
Yeah, it is selling, but
so your losses are unlimited.
But collateral
Unlimited.
is only 1,000.
but collateral, yep.
Okay. Is there a risk
1,000
profile
in
calculator
In
for
BTC.
this? Is there a risk profile calculator for this? I guess.
You can calculate the probability of exit from this range, and it approximately 8% in that case. We
Based on
can
historical data, yeah.
basic different Greeks. Greeks, it is some.
Theta decay.
Hmm?
Theta decay here in terms of time, no?
One of the Greeks, it is delta, theta, gamma, and delta. It is Vega. Delta. It is Greek that shows us approximately probability of reaching this target, and average probability to reach 27K or 45K, approximately 8%. Yep.
It's kind of schemes for hedging.
Let's try to build a few other constructions. It is sell put. It is buy put option. Yeah, but I have unlimited profit. When you use option, you will pay for each this part of your yield profile, and I don't want to have unlimited profit. I have fixed loss, approximately 4,000, and unlimited profit. If I sell one more put option with strike 40K, this construction will named as spread, put spread. I will reduce my loss, but I will have limited profit. And in case if I sell one more put option with strike 30K, I will have back spread, and my losses will significantly reduce it, and it will be approximately 2,000. But my profit will grow a little bit, and I will have unlimited loss when price hard falling. And if I want to hedge this part of my return profile, I can buy one more put option with strike, for example, 24, 23 to 24 put. And in that case, I will have fixed risk on all price scale and limited profit, but really high probability. In case when price will down, I will have good return, risk reward profile, because in that case I will risk, for example, 2,000, and maximum profit is approximately 4,000. And this construction is named as butterfly, because it has fixed. Okay, butterfly. And I think that in nearest time, the most popular combinations, these constructions, will be long combo and short combo, because it is almost it has almost they have almost profile as future market profile, but with some safe place, safe zone. I don't know. For example, Bitcoin price approximately, for example, 37K. And if I want to bet on fall of price, I will use short combo. In that case, I will have safe zone, for example, till 40K. I can try to show this. PB. Yep. For example, if I have a short prediction, fall prediction for Bitcoin, I can buy, for example, 33K put. One. Long. I can buy put option.
How about hedge?
And I can sell, for example, 39K call option. In that case, I will have fixed profit from 33 till 40K, 39, and my profile will be, this green line will be the same as future market. But in future market, when you use short on futures, in case when price up to 40K, you will have lose approximately 3,000. Okay, approximately 3,000. But on when you use this construction on options, you can wait sometimes, and this green line will be closer to purple line, and in that case, time on our side. We can open short position and wait some time. In case when price will grow significantly, for example, I don't know, 45K, loss will be lost, will be the same as on future market, and it means that benefit between option trading and future market that you have some safe buffer, yeah, from 34 till 40, for example. Now 35, from 35 till 40, you will have some safety buffer, and your loss will be, you will not have any losses, because it will be profit, for example, 300 now. That's all. Thank you. Yep. If you have any questions, I will be here.
So the next speaker is Mitro, Dima. Now the arbitrage funding rates. Саша, да? Да.
Нажми. Сейчас. Углушим презентацию. Okay, guys. So my name is Dima, and let's talk about arbitrage funding rates. First of all, a bit of disclaimer. I've got extremely bad vision. I cannot see your faces from here. No problem. It will not help. My English leaves much to be desired. So I apologize for any typos or for any mistakes that can appear on this presentation and during my speech. And last presentation that I did was about 20 years ago, and pretty old one. So don't, well, apologize me for this. Basically what we do. Thank you. What we do, it's a kind of TLDR. We last 6 months we experiment with arbitraging of funding rates. Who know what is funding rates for the futures? Everyone, almost everyone. So basically, we do selling. We do entering short position on one exchange and entering long position on another exchange, and earning the difference between funding rates on different exchanges. We use both DEXs and SEXs exchanges. But for those who doesn't know what is funding rate, a bit of history and a bit of explanations how futures work. Futures, unlike options, are the obligations of both parties, I mean buyer and seller, to fulfill their obligations with this transaction when the future date comes. I mean, the future is a derivative agreement to buy or sell certain asset in the future at predetermined price is predetermined today. So both parties are obliged to fulfill their obligations when the time comes. Futures appeared first. They're known from ancient Greece, but first standardized future contracts were implemented in Chicago on grain exchange in 1865, and in 1992, Chicago Merchandise Exchange implemented electronic trading by futures. Who knows what is contango? Oh. Back? Questions? No? Okay. Contango actually is normally the spot price is below the futures price in most cases. Futures price is normally up over the spot price. And this situation when the futures price differs from the spot price is called contango. Also, the premium between futures price and spot price is called contango. And here comes the first option to arbitrage. Here is today's situation. Bitcoin futures expiring on Binance, expiring 29th of March 2024, is sold at 37,800 something, almost 900. And at the same time, the spot price is 36,500. Yeah. 36,500. So there is a difference. If you sell futures and buy spot Bitcoin for the same amount, you on the 29th of March anyway will earn about 1,500. Deribit went further. They even show this premium annualized. As you can see, it shows that the premium between spot price and futures price is about 9% annual. And this way of arbitrage is called cash and carry arbitrage. It's rather simple. You sell futures, you buy spot if the price is over the spot, and by the date when future contract expires, you earn some money. What I wanted to say. Wait a moment. Tango. The problem, however, here is that when you buy or sell futures, you can do what is called margin trading. So you can use like a very small margin, like 10% of your position, or even 1% if you are risky enough of your position to buy this or to sell this futures contract. But on the spot, you can also use margin trading. But when you borrow some asset from the broker, it will cost you money, unlike with the futures. So probably if you borrow Bitcoin or USDC from the broker to buy this Bitcoin, it will cost you more than 10% annual. So you should take it into the account when you are calculating your position. Perpetual future contracts. Actually, I wouldn't call them futures, but it's a tradition, and some exchanges call them perps, perpetual swaps, just perpetual contracts. First, they were offered by Robert Shiller. Here's he receiving his Nobel Prize, not for the futures. And firstly, electronically, they were implemented in crypto by BitMEX in 2016. The question here, if about Contango and about this premium. Let me come back. As you can see on this chart, the price of the futures at the end, at the date of the futures expiry, at the maturity date, will always be equal to the spot price. Otherwise, it will not work. So how can we do this if the future contract doesn't expire with the perpetual futures? The solution was found in funding rates. Funding rates is a kind of fee or rate which either shorts pay to longs or longs pay to shorts, depending on the market situation. If the futures price is over the spot price, that means that the prevailing position on the market is longs, buyers. That means that the exchange has to incentivize short sellers to sell more, at the same time to de-incentivize the longers to sell less, otherwise the price will fly into infinity, fly up. That's why they implemented this funding rate, and the funding rate in this case will be never negative for the longs. Longs will pay to the shorts. If this situation is opposite, if the prevailing position on the market is shorts, the funding rate will be negative for the shorts, and shorts will pay to longs. Is it clear?
Yes. How often is this payment done? Is it like a regular payment?
Yeah, it's regular payment. It can be done on centralized exchanges. Is done mostly in once in an hour or once in 8 hours. On decentralized exchange, it can be done by transactions. As soon as transaction is recorded into block, it records with the funding rate.
And as I understand, the more the spread between, like,
yeah, the higher the rate is. Yes. There are two main mechanisms or mechanics that exchanges use to calculate these funding rates. On centralized exchanges, it depends on the difference between mark price and index price. If you look at the interface of where is it? I'm sorry. Is there mark price and index price here? No, and there a bit it's in the order book. You cannot see it here. But on the Binance, for example, if you go to the standard interface on Binance, you will see index price and mark price. Index price is something that Binance relies on. It can be a spot price. Some exchanges use as an index price prices from other centralized exchanges and do some combined mix. For example, Deribit does like this. Mark price in most cases is the price which is calculated basing on the order book and last deals that were made on these exchanges. So if the mark price is over the index price, that means that prevailing position again longs, and they have to do the funding rate negative for longs, positive for shorts. So longs will pay to shorts and vice versa. With the decentralized exchanges, I will speak now about the most interesting representative of this community called synthetics, and the exchange is called Quanta actually, but it is based on synthetics protocol, and it uses mechanics of synthetics. By the way, it's about SEX. It's about this is Deribit. It's a centralized exchange where the previous speaker used to trade options. They trade also futures, and here is the perpetual future for Cardano ADA. As you can see here, the 8 hours rate is 0.22. If you multiply and find the annualized rate, it will be about 230%. That means that this amount every 8 hours will be paid. It's not by on Deribit. It's not every 8 hours. It's I think maybe every minute or every 1 hour. It is paid by longs to shorts. So if this figure is positive, then that means that shorts earn. So if you go short with ADA on Deribit, you will start earning this 230% annual. If you go with leverage 10x, your earnings will be 2,300. Hedging, as I told before, to hedge this, you have to find another exchange where this funding rate is sufficiently lower or even negative, and open long position there. Thus, you will receive a joint neutral position, and you will earn this 230 or 2,300% of yield. But the disadvantage here is that if you can look at the chart of funding rate, the red line here is the price chart, and the blue line is the chart of funding rate. You can see that it is hardly predictable. It moves very fast. It spikes here. It's just 24 hours chart. 24 hours chart. So it moves fast, and it doesn't mean that you will be always for the even 24 hours earning this 0.22 per 8 hours. It can change very fast. Coming back to decentralized exchanges, Quenta and Synthetics implemented another mechanics for funding rates. It is based on so-called skew, this one. It's the proportion of longs and short open on the exchange. The more, let's say, the basic situation of the funding rate must be zero. If at a given point of time it came to zero and the quantity of longs and shorts became equivalent. But if, for example, some shorts are liquidated, the price goes up strictly, shorts got liquidated, the quantity of shorts reduces, the quantity of longs is too big, that means that longs are prevailing. Synthetics start incentivizing short positions, short sellers to go short. And the skew, until the skew is 50-50, the funding rate will keep growing. It will grow. It can grow to 400% annual, 500% annual. I don't know. I saw maybe it can be like 1% and 1,000% annual. I personally saw like 700% annual. And the advantage of Synthetics and Quenta is that this funding rate is not moving so fast. It's not well, you can look at this chart. It's 1 month chart. You can see that most of the time it is about the zero line. It's positive. And if the previous chart was on Deribit for 24 hours only, and you saw very sharp moves there, here the moves are not so sharp. That means that you can predict a bit, at least a bit, how the funding rate will behave. So basically, What we do is we go short on one exchange, go long on another exchange, hedging. For example, on Binance, most funding rates are in between from 11% annual to minus 11% annual. For example, you can hedge. Here we have link, and it has now 42% annual. You can go long on Binance and pay 11% annual. So the difference is 42% between your short and long. And multiplied by the leverage, it will be like 400% annual, something like this.
It's like 8 hours funding rate.
No, it's annual, 1 year.
It's annual. I also hope it is.
So maybe a stupid question. How? I mean, if you open like a long and short position, how fast can you enter the position next to the position? Like in case of futures and options, there's like a date where
it's perpetual.
Basically, and if it's perpetual, I guess you can enter an next position at any point. Yes.
Any
And
point.
if it's why not just monitor the skew with a specific tool and just enter the positions and exit the positions so the skew is in a specific range? Why would
That's what we're working on.
Oh, so it's like it's such an obvious thing.
No, it's not so easy because you have to monitor other exchanges. You have to find the hedging situation because, for example, sometimes you see very attractive situation on link like 52%. You go to Binance and see minus 52%. The same situation. No point to hedge. So you have to do some aggregator which will
Connected to APIs and check them?
Yeah, but it takes time. It takes money. It's not so easy.
Okay. So you're always looking to hedge with another perp, or you always go for the spot?
Not spot. We tried hedging by delivery futures, not perp. But spot, you see, it doesn't worth doing by spot because here you have leveraged position. In most cases, we go with a leverage like 5x to 10x, depending on the market volatility. And if you go with spot, the efficiency of your equity will not be so good because on spot, either you have borrow and pay the borrow rate, and it can be depending on the appetite of Binance, it can be the same 52%, or you can, if you don't borrow, just the efficiency of your capital is not so good. So tools we use. I will not go. You can take a picture if you wish. There is 2 websites, Coinalyze and CoinGlass, which offer like a table of so-called, let's call it, arbitrage opportunities, where you can see the funding rates between different exchanges and different tokens. But they do this only for centralized exchanges. No such a tool for decentralized exchanges. This is another opportunity for startup.
I have a question.
Yep.
Are there tools already that have that automated for you, where you invest and they do the arbitrage for you?
No.
And who would be the oracle?
No, not yet. Who would be the oracle for what?
For like the validation of the funding rate.
Between centralized exchanges or
decentralized exchanges.
Decentralized exchange? I don't know yet. I don't know how this is the option to develop.
What's the name of the project?
We don't have name yet. We're just earning money. We're not doing this arbitrage, let's say, tool yet. Yes. Yes.
What are the? I didn't really get what are the risks in this case. I mean,
here they are.
Okay.
First of all, since we do it manually, let's say there are how to say, fees and charges which you must take into consideration. And fees and charges on decentralized exchanges in most cases are higher than on centralized exchanges. For example, on the same Quanta, you have fixed fee of $2 per any transaction. You cannot go with a small transaction that just because you cannot trade like for $100 because your commission will be too high in this case. You will not earn anything. So you should take into account fees and charges, and since you want to reduce the probability of spread between your long and short positions, you should open two positions as fast, as simultaneous as possible. For this, you have to use market orders, and this means that your fees and charges will be higher because taker orders, market orders are usually taker orders, not maker orders. On centralized exchanges, taker orders cost more than maker orders. By the way, on Deribit, if you would like to know, maker order on the futures cost zero, nothing. So second thing, you should take into consideration funding fee on the hedge side. So when you are opening, let's say, the same link on Quenta, you should study what will be the link funding fee on the exchange where you're hedging your position, for example, on Binance or Deribit or whatever, and how it behaves. You have to look at the chart and look at how it behaves. Ой, I'm sorry. Влад. 4. You should take into consideration trade spreads, especially when the market is moving very fast. You know that when you work on this manually with these orders, you have always temptation to open the hedging position with a limit order to try to earn something, to spare the maker, to receive maker commission, not taker commission. And from time to time, it happens when you set your limit order and the price goes to the opposite direction heavily. And there are 2 days you cannot sleep because your position is not open, the market is going down or something like this. So it's not the way it should be done. And but when you open the market orders, both orders with market orders, you should take into consideration spreads. They can also affect your position. Funding fee can make a U-turn. Let's say, for example, if there are a lot of now you have skew positive for shorts. If there appear a lot of shorts, the funding fee on Quenta starts to decrease and goes to the negative direction. Let's say you should take into account and monitor this also. Lack of liquidity. Yes, there are positions that you just don't have enough liquidity. You cannot open a position for let's say, I don't know, $50,000 or, and opening a position just for $5,000 not always worth it. And of course, all these risks that Vlad told us about, risks of the exchanges, risk of stable coins. For example, on Quenta, your positions are linked to SUSD. It's a synthetic stable coin. And on Binance, you trade normally with USDT. Normally, they go like one to one. They're pegged, but sometimes they can be depegged. Even USDT can be depegged. A couple of months ago, maybe half a year ago, we saw USDC depegging. So basically, there are a lot of risks, as in every crypto strategy. So what's next? Now we're working on automation this strategy. We are going to, we are considering making this aggregator for the DEXs, as you mentioned. And of course, there will be a dashboard and control panel to manage your positions and to see all the statistics. By the way, it's very interesting, but both decentralized exchanges and centralized exchanges, they don't show you all the net profit that you earn. They show you as your P&L just difference between the price you sold at and bought at, but they don't take into account your commissions that you paid to them. You have to search them separately. Funding fees that you paid. BitMEX does. I didn't try. I registered, but I didn't try. So basically, that's it. If you have any questions.
Could you share your thoughts about the market before FTX crash and after FTX crash?
I'm sorry?
Could you share your thoughts about the market before FTX crash and after FTX crash? Meaning of liquidity, depths, volatility, and so on. Probably not very.
No, you know, I monitored. I was in DeFi already, by the way, when FTX crashed, but I was not in this funding fee arbitrage yet. So I cannot tell you anything about funding fee arbitrage at that time. But yeah.
How long I do it?
Half a year.
Half a year. So only the time when the market is volatile, right?
No. Market is volatile just last 2 months, maybe month. When we started when we found this option, opportunity.
Yeah, quick question. How realistic, how often does it happen that funding rates are really different, opposite? Because normally they should reflect market sentiments and should be like same on all exchanges. For example,
they cannot
even on short and negative or not, but in reality they're different. So why there is this disbalance on different?
Because different exchanges have a different algorithm of calculating these funding rates, and they have different level of liquidity, and they have different order books. Many. Yeah.
To always find this the natural.
So far, yes. Yes.
So basically, you add exchange inefficiency to market inefficiency, and this way you kind of.
Yeah, that's right.
Have you ever faced some kind of a drawdown on your position when you do the arbitrage?
Yeah, it's a good question.
What do you mean?
Like a huge drawdown of your position, that means that your actual position was big, and the actual price went against your position. That means that you kind of went into.
Yes, of course. So you just add margin. You have to have spare capital. But by the way, if you, for example, have a short and long position, your short position on Quenta, for example, or long position on Binance, and long position is growing, for example, Bitcoin, and short position on Quenta is going down, you just have to withdraw some money from Binance, transfer them to Quenta, and increase your margin in Quenta. But of course, manually, you are not always fast enough to do this. Excuse me?
Did you have any liquidations?
Yeah, sure.
It's a lot of work, like monitoring this.
Yes, you have to, when the market is volatile. For example, a couple of weeks ago, before the recent spike of Bitcoin, I was hedging with 10x. When the market started to move fast, actually, I was liquidated on the first move on Bitcoin. It was unforgettable experience when I was on my mobile trying to close the position. It was not closing, but the Bitcoin price was like on my eyes. Within 2 minutes, it was going from 32 to 34 plus thousand. But anyway, I closed the position with profit because I closed first short position, not to get liquidated. And yeah, and I closed the long position after this, and the price was higher than I closed the short position at that time. But yes, manually, you have when the volatility increased, I decreased my margin to 5x, to 4x.
Can I ask, how often do you enter and exit the position? I would imagine that high frequency traders, when bots gaps are closing pretty fast between the different funding rates?
I don't do very fast actually. I managed to deploy like $100,000 as a deposits. I mean, that means that I had positions open for about 1 million, something like this. And normally, you know, to earn something on the funding rate, you have to wait certain time, and your position will not earn anything if it stands less than, let's say, 3 days. I think it's absolute minimum. It depends on the funding rates, depends on the situation, market situation, but normally not less than 3 days. So if you, let's say, deploy 10 positions by $10,000 each, you have nothing to do. You have just to monitor these positions. It's not very often. Like I can do. The more often you do, maybe the more often the more you earn. But for now, I do like maybe. Last week I was traveling. I opened just one position and closed one. That's it.
What is your APY for like
150
for like 6 months? You earn
150 APY annual.
APY annual. So you
Yeah.
earn for 6 months like 75%.
Yeah, something like this.
Do you see these inefficiencies mostly between SEX and DEX, or also between different DEXs, for example, Quenta and GMX?
GMX is a weird DEX actually. They don't have this funding rate. They have some kind of borrow rate, rollover fee. So and they have huge fees. So GMX will not. Yeah.
But in V2 they have the funding fees now, right?
I didn't check.
Okay, they have the V2 now, which has.
I have to check. We tried using PERP. We tried using DYDX.
Yeah.
We tried using Apex, I think. No. But in most cases, the most efficient way for now is either between sexes or between Quenta and sexes. So for DEXs, the most efficient is Quenta.
What is your best case with this arbitrage?
The best case actually between
Maybe not money, but
between DDBit and Binance, I was in position for Matic for about 2 months. The position was open just with deposit of $3,000, and the profit was about $6,000.
you hold the position for 2 months.
Why didn't you do the same with earning your interest from the options, from the premium, like collecting the premium when you get a position there?
I just didn't dive deep into it yet.
Check it out.
Yeah,
I can't imagine how you do this, man. It's crazy.
But it's a good idea.
How do you decide on when to close the positions?
Yeah, good question.
If you are close to liquidation and you don't have option to increase the margin,
But
if the funding rates is negative for you, you close also. But not necessary, like not at the same moment as it became negative. As you can see, for example, here, Link most of time was over the 0 point. It's over 0, but sometimes it goes down, like here, like here, like here, like here, for a very short period of time. So normally, if, for example, in case with Link, if I don't see it minus 50 for me, minus 50% annual for me, or if it's in the negative zone for less than, let's say, 2 days, I don't close the position, because exiting the position and entering the position will cost me more.
Yeah, it should be somehow balanced or weighted. It's not like a direct stop loss.
Yeah.
Immediate difference.
Yes, right.
Do you need cashbacks?
You want to offer?
No, just interesting.
What do you mean?
In your strategy.
What do you mean?
Do you need cashbacks?
What do you mean?
Cashbacks?
What do you mean?
I mean, for example, there are guys who offered 30% discount on Binance trading fees instead of 20%, which you can do with just referral link from you to you. And I think it's you can do more cases with other exchanges.
Can be. I need to think about it. I never thought about it. Okay. So thank you very much.
Thank you.
So, questions is done? If yes, we will have a pizza in 10-15 minutes. So enjoy it in the court. Also, we have water here and cola.
And wine is over.
Some of them yes, some of them not.
It was most fun and amazing. Thank you.
What did you do? Perpetual futures.
Yeah, so what is the
Да, иди сюда.